Transfer pricing is the price goods and services are transferred from one division of an organization to another. It is used to record and control the use of resources across the organization. It is a way of promoting divisional autonomy and can be used as a form of divisional performance measurement. The 5 characteristics of good transfer pricing are goal congruence, fairness, autonomy, bookkeeping, and the minimalization of global taxation. Goal congruence. The transfer price that is negotiated and agreed upon by the buying and selling division should be in the best interest of the company overall, taking into account taxation, import duties and tariffs, currency fluctuations, and so forth. Fairness. Transfer price should be perceived as being fair for the purpose of performance evaluation and investment decisions. Buying and selling divisions will be treated as profit centers, and the transfer price must be perceived to be fair, in that it should allow the performance of each division to be assessed. Ideally, the transfer price should permit each division to make a profit. Profits are motivating and allow divisional performance to be measured using positive return on investment or positive residual income. Autonomy. Preserving divisional autonomy will improve management motivation. Bookkeeping. Transfer pricing should be straightforward to record. Minimization of global tax liability. Transfer prices can be used within multinational companies to move profits from high tax economies to low tax economies, thereby reducing their global tax liability. Governments will be very interested in multinational transfer pricing, as they will want to ensure that profits are correctly accounted for in their jurisdictions. There is extensive anti-avoidance legislation in this area. The aim of a good transfer pricing system is one where the transfer price provides an artificial price for the organization's divisions, allowing the transferring division to earn a return on its efforts. With some organizations, negotiation is used for transfer pricing. The minimum price is determined by the supplying division. Here the transfer price will be greater or equal to the marginal cost of the supplying division. The maximum price is determined by the receiving division. Here the transfer price will be greater or equal to the net marginal revenue of the receiving division. Negotiation between divisions is used to agree on a price in between the minimum and maximum price. The transfer price used depends on what the organization is trying to do, the general rules being, where there is a perfectly competitive market for the product or service charged. Transfer price should be the market price or the market price less savings in selling costs. Care must be taken to ensure product is the same as market product. The supply division would not want to supply the internal division with a product or service at less than the price they would achieve on the external market. Where there isn't a perfectly competitive market and the supplying division has spare capacity, ideal transfer price will be the standard variable cost of production. The supply division would prefer to use actual costs as opposed to standard costs, but the use of standard costs will encourage the supplying division to control costs. Standard cost is used to avoid inefficiencies being passed from one department to another. If actual costs were used, the supplying division would have no incentive to keep a control on costs, because another division would be paying for it. Plus, the use of standard costs allow the buying division know what cost the transfer will be in advance, rather than waiting for the actual cost to be worked out. Where there isn't a perfectly competitive market and the supplying division has to use a scarce resource, the ideal transfer price will be the variable production cost plus the cost of the lost contribution of using the scarce resource, instead of putting the scarce resource to its most profitable alternative use. This is the standard variable cost plus the opportunity cost. Alternatively, dual prices may be used. This is where the supplying division records one cost, with the receiving division recording a different price. With this method, divisional current accounts will not agree, and some period-end adjustments will be needed to reconcile those, and to eliminate fictitious interdivisional profits.